While Steve Eisenman and Michael Burry have shot to fame due to the critically acclaimed film The Big Short, documenting their bets against the US housing market during the 2008 financial crisis, another investor who openly avoids the media and rarely gives interviews was making the greatest trade the world had ever seen. John Paulson was also betting it against the US mortgage market, but his profits dwarfed those of Eisenman and Burry. Let's take a look at how he did it. John Paulson was born in 1955 in Queens, New York, to Alfred and Jacqueline Paulson. He attended local public schools in New York and excelled in academics. He set up his own business at school but realized that sales was not his thing, so enrolled at New York University. After attending NY University and Harvard Business School, John earned the nickname JP after JP Morgan due to his exceptional abilities. After graduation, Paulson had a successful career on Wall Street and gained a reputation as a playboy. In 1994, this started to lose appeal, and John realized he needed to become more focused if he wanted to create substantial wealth. He decided to start up his own company called Paulson & Co., which focused on John's specialty trading styles, known as merger arbitrage and bankruptcy restructuring. He had a lot of contacts from his time on Wall Street and sent out 500 letters asking for investment. No one replied, leaving Paulson to start the fund with just $2 million of his own money. Some of this money came from his successful career, and the rest from a speculative investment in his friend's brewery startup that grew to become the Samuel Adams brand. After no one invested in his fund, Paulson asked his father if he was doing something wrong. He replied with his favourite quote by Winston Churchill, "Never give in." 10 years later, Paulson had $2 billion under management and worked hard to get investors into the fund. He failed to attract the larger investors due to his research-heavy strategy when many of his rivals were using computer-based models which were highly complicated. Despite having $2 billion under management, the company only had 9 staff. One of these employees was an analyst named Paolo Pellegrini. A hedge fund having analysts is not surprising, but Pellegrini's story is. He initially applied to join the company as chief financial officer, but when Paulson told him the role had been taken, he asked to join the firm as an analyst. Paulson was surprised that a highly qualified investment banker had asked for such an entry-level role suitable for a college graduate rather than experienced Wall Street veterans. However, he accepted his request, and Pellegrini joined the firm in 2004. As house prices rose significantly in the United States after the Federal Reserve slashed interest rates after 9/11, mortgage providers also pumped up the market by giving large amounts of money to borrowers and merely packaging up these loans and selling them on to investors. This meant companies were relaxed with their lending criteria and pushed for more people to be given loans, regardless of their credit history or income. Paulson became worried as the Federal Reserve increased interest rates in 2004, and he looked to buy protection. The most obvious solution was to buy put options on the S&P 500, which would pay out if the index fell. But these were very expensive, as other investors had a similar idea. Paulson continued to look for ways to protect the portfolio due to rising borrowing costs caused by the Federal Reserve, but nothing seemed suitable. This provided Pellegrini a chance to show his worth. He suggested that the firm buy credit default swaps that provided insurance. Paulson's company would pay annual premiums, and if the stock prices fell, they would receive a large payout. If they rose, Paulson would only lose the premium that he had paid. Paulson told Pellegrini to research the swaps against leading financial companies to see how they worked. They arranged a number of talks with investment banks to understand if this was possible and how it could be done. However, after taking a position in the swaps, the company only made small losses as debt levels continued to grow. They changed track, seeing if it was possible to short the mortgage market rather than individual companies, as their prices wouldn't rise should a takeover occur, like financial companies, who had gone through a boom period of M&A activity. Paulson liked this idea and brought in a number of experts to teach them about the mortgage market, and they were amazed that there were so many different categories for subprime mortgages, which were the riskiest mortgages approved by lenders. Paulson and his team became experts in the credit market, and by the end of 2005, Paulson and Co. owned credit protection worth $100 million, while paying only $1 million premium for them. Paulson wondered why no one else had the same idea, as Wall Street banks continued to borrow, unaware of the problems that they may face in the future. No one expected the mortgage market to fail, as there had never been a default on an investment-grade mortgage-backed security, according to the ratings agencies who ranked the mortgages. Mortgage-backed securities were viewed as sacred investments alongside US government treasury bonds, but what many missed was the poor underwriting and ratings that the mortgage-backed securities had been given. At a meeting, Pellegrini spoke with the CEO of New Century, a loan provider for customers with bad credit. Pellegrini asked him if he was concerned about defaults rising and what effect that would have on the company. He coolly replied that New Century would merely refinance the loans if defaults occurred, as the rising house prices would cover the owner's home costs and lead to no defaults. After hearing the news, Paulson realised that they had made a big mistake. The protection that they had bought wouldn't pay out, as many properties had increased enough to cover the cost of the homeowner's mortgage should they come close to defaulting and simply refinance their loan. Paulson sold his swaps and started buying more recently packaged subprime mortgages, whose properties hadn't gone up so much in price and would be more difficult to refinance if interest rates increased. They needed the real estate market to hit unstable prices and fall, which would hopefully trigger a collapse in the housing market as people would default and be unable to refinance. This seemed unlikely, as house prices hadn't declined on a national level since the Great Depression of 1929. Pellegrini continued to carry out research, finding that house prices had increased drastically over the last 7 years, and they needed to fall about 40% to match the trending price for the previous 30 years. He realised that every time the market dropped, the prices fell below the trend line. This meant that any future correction would be extremely severe. Pellegrini showed his findings to Paulson, and they finally had the evidence they needed to show the housing market was a bubble. Even if house prices only flatlined, homeowners would be under extreme pressure and increase the likelihood of a default. A fall in a house price by just 7% would lead to losses of 17% on average on a mortgage taken out against a home in the United States. Paulson bought more and more protection, purchasing up to $500 million per day while only paying a 1% premium, as there was almost unlimited liquidity for the swaps. Some days the firm bought $1 billion of protection. By mid-2006, they had bought as much protection as possible and tried to stay quiet on their findings. This proved difficult, but Paulson and his team managed to raise money for a new fund to continue buying protection. They only raised $147 million, which included $30 billion of his own money. The fund split trades between CDS contracts on selected mortgage bonds and was shorting the entire AVX subprime mortgage index. The brokers Paulson used were so shocked that anyone would try and short the market and tried to convince them not to buy the CDS contracts. Word went round that Paulson held a significant amount of protection, and money began to flow in as investors became wary of the rising markets. The fund had $700 million under management, and it was spent entirely on protection against the housing market. Another sister fund was raised so that even more contracts could be bought. Paulson began to wonder what would happen if a crash came and who would pay out when the markets fell. If the companies selling him the insurance were struggling, they may not pay out the insurance that he had purchased, resulting in large losses for his funds. Even more worryingly, should the investment banks who sold Paulson the insurance go under, it would threaten the world's financial system. One of the companies Paulson shorted was New Century. They produced excellent results quarter after quarter as mortgage approvals continued to increase, but Paulson stood his ground and continued to short the shares. In February 2007, New Century announced their results for the fourth quarter of 2006. So many customers were struggling to pay their loans that the company had taken them back to avoid defaults. The following day, New Century's share price fell 33% and resulted in Paulson making his first big profit. The ABX index also dropped on the news, giving Paulson even more profits. For every point the ABX index fell, Paulson would make $250 million. A few weeks later, the fund reported its monthly results to investors when a client told Paulson about a misprint in the results. The document said the fund had made 66% in February, when it should have said 6.6%. In fact, the investor was wrong, and the results were correct. Paulson was flying. The results made Paulson famous around the world as newspapers wrote about his exceptional returns. As the real estate market continued to fail, those exposed to subprime mortgages, such as Bear Stearns and Lehman Brothers, attempted to prop up the market. Paulson refused to sell the CDS positions he had accumulated despite pressure from investors and Pellegrini. He thought the $2 billion profit was just the start and that there was a lot more to come. Paulson aimed to exit his positions so that the financial institutions who sold him the protection could pay out just before they went under. He and his team tried to work out which banks were the most exposed to the crisis, but their results showed nearly all the banks held significant exposure. CDS protection against major investment banks was still cheap despite this, and Paulson started buying protection against the debts of major financial institutions. As the financial crisis took hold, Paulson began to offload his positions before it was too late. By July 2008, subprime investments had crashed, and Paulson had exited nearly all of his positions. In only 2 years, Paulson had invested $1.2 billion in protection across 2 credit funds and made a profit of nearly $10 billion. Paulson's other funds also made significant gains, resulting in him making one of the greatest trades of all time. In total, Paulson returned over 800% that year. After all the profits, he had to write a check to the IRS of $1 billion to pay his income taxes. And while he doesn't keep the check, he still has the old tax returns documenting the enormous amount. Pellegrini, Paulson's right-hand man, made $45 million in bonuses for his part in the trade and shocked his wife when she checked their balance at an ATM in the Caribbean. Paulson made $4 billion in 2008, the largest one-year payout in the history of the markets, rocketing him to the elite of hedge fund managers. By the end of 2008, Paulson's hedge fund managed $38 billion, making it one of the largest in the world. Since the financial crisis, Paulson has struggled to match his success. While it is unlikely that anyone will be able to find opportunities on this scale, failed bets on healthcare, gold, and pharmaceutical stocks by Paulson & Co. have seen assets under management fall from $36 billion in 2011 to $16 billion in late 2016 to $10 billion in 2020. He still feels that credit is mispriced, and there is a large potential as inflation surges around the world. As interest rates rise, the value of bonds will fall, providing a shorting opportunity that will provide very high returns. Paulson is also bullish on gold due to the risks of inflation. He has made some trades that have returned 50 to 1, but these have been on a smaller scale than his subprime bets.